If you're planning to retire in the next few years, 2026 is not a year you want to sleepwalk through. There are new 401k rules kicking in, there are tax brackets shifting, there are healthcare costs that catch even careful savers off guard, and there's a mountain of conflicting advice out there telling you to panic, to freeze, or to just wing it. Here's the truth, none of that is necessary. What you need is a plan. Not a vague idea of, I'll retire when I feel ready, but an actual structured exit strategy. The same kind of thing a company uses when it winds down a project. Clear phases, clear order of operations, clear contingencies. Today, I'm walking you through exactly that. A 5-step retirement exit strategy built specifically around what's changing in 2026. The new 401k contribution and catch-up rules, the order you should actually pull money from your accounts, and how to plan for healthcare costs before Medicare kicks in. And if you're already 55, 60, even 63 and thinking, I probably should have started this years ago, stick around, because step 1 of this whole framework is built for exactly that person. It is not too late to get this right. Let's get into it. Before we get to the 5 steps, you need to understand what's actually changed, because your strategy has to be built around the current rules, not the rules your parents retired under. The biggest shift comes from provisions tied to the Secure 2.0 Act, many of which are phasing in around this exact period. First, catch-up contributions. If you're 50 or older, you already know you can put extra money into your 401k beyond the standard limit. What's new is that for higher income earners, those catch-up contributions are shifting toward Roth treatment, meaning after-tax dollars going in rather than pre-tax. That's a meaningful change in how your tax bill looks today versus how your withdrawals get taxed later. Second, there's an enhanced super catch-up contribution window for savers age 60 to 63. This age band gets a higher catch-up limit than everyone else. If you're in that 4-year window right now, this is one of the most powerful time-limited opportunities in the entire tax code for boosting retirement savings fast. Miss it, and it's gone. You age out of it. Third, required minimum distributions, RMDs, have a later starting age than they used to. For a long time, it was 70 and a half, then 72, and now most people are looking at age 73, with a further step up to 75 down the road for younger cohorts. That sounds like a small technical detail, but it actually changes your entire withdrawal sequencing, because it gives you more years where you control when income hits your tax return, instead of the government forcing your hand. Fourth, employer matching rules have evolved too. Some employers can now offer matching contributions into your 401k based on you paying down student loans, not just on your own contributions. And Roth options inside employer plans are far more common than they were even 5 years ago. Why does all of this matter for someone planning their exit? Because your entire retirement withdrawal strategy is a tax optimization problem wrapped around a cash flow problem. When the rules for contributions, catch-ups, and mandatory withdrawals shift, the optimal order in which you tap your accounts shifts with it. So with that landscape in mind, let's build your 5-step exit strategy. Here's the big picture before we go deep on each one. Step 1 is the timeline and income audit, figuring out exactly when you can realistically exit and what income sources you'll actually have. Step 2 is maximizing your final working years, using the new 401k and catch-up rules to squeeze the most value out of the time you have left in the workforce. Step 3 is designing your tax-efficient withdrawal sequence, the order in which you pull from taxable accounts, tax-deferred accounts, and Roth accounts. Step 4 is healthcare cost planning, specifically the gap years before Medicare, plus what happens once Medicare starts. Step 5 is the legacy and contingency layer, protecting the plan from the things you can't predict, like market downturns, long-term care needs, and estate considerations. Each step builds on the one before it. Skip one, and the whole structure gets shaky. So let's go through them properly, one at a time. This step is deceptively simple, and it's the one most people rush through. The goal here is to answer one question with total honesty. On the day you stop working, where does your money actually come from and how much of it is there? Start by listing every income source you'll have access to. That typically includes Social Security, any pension if you have one, withdrawals from your 401k or 403b, withdrawals from an IRA, distributions from taxable brokerage accounts, and possibly rental or part-time income. For each of these, you need to know two things: when you're eligible to access it and what it's actually worth today. This matters because retirement isn't one single start date. It's a staggered unlocking of different income sources at different ages. You might access a 401k penalty-free at 59 and a half. Social Security has a range from 62 up through 70, with your monthly benefit changing significantly depending on when you claim. Pensions often have their own specific eligibility windows. The audit also means getting brutally honest about your expenses, not your hopeful estimate of your expenses. Pull your actual spending from the last 12 months. Separate it into essential, housing, food, insurance, utilities, debt payments, and discretionary, travel, hobbies, dining out, gifts. Why the split matters. Essential expenses should ideally be covered by guaranteed, non-market dependent income like Social Security or a pension. Discretionary expenses can be more flexible and tied to portfolio withdrawals, because if the market has a bad year, discretionary spending is what you trim first, not your mortgage payment. Once you've mapped income against expenses, you'll land in one of three zones. You're fully funded and could exit now. You're close but need a bridge of a few years. Or there's a meaningful gap that needs either more working years, adjusted spending, or both. None of these are bad news, they're just data. And that data is what makes the rest of this framework actually work instead of being guesswork. One more thing on this step: redo this audit every year until you actually retire, and again in your first few years of retirement. Your numbers will shift, markets move, health changes, family situations evolve. The audit isn't a one-time event, it's a habit. This is where those 2026 rule changes become genuinely useful, not just background noise. If you are between 60 and 63 right now, pay close attention, because this window is arguably the single best opportunity you'll get to close a retirement savings gap quickly. The enhanced catch-up contribution limit available to this age band is meaningfully higher than the standard catch-up amount available to other savers over 50. If your plan allows it and your budget can stretch to it, pushing your contributions to the maximum during these specific years can meaningfully change your account balance by the time you exit. Next, think carefully about the shift toward Roth catch-up contributions for higher earners. If your income puts you above the relevant threshold, your catch-up contributions may need to go in as Roth dollars, meaning you pay tax on that money now instead of later. This isn't necessarily bad. In fact, it can be a hidden advantage. Roth dollars grow tax-free and come out tax-free in retirement, and they're not subject to required minimum distributions during your lifetime. If you're in your final working years and expect to be in a similar or higher tax bracket later due to RMDs, pensions, and Social Security stacking up, paying tax now on catch-up contributions can actually reduce your lifetime tax bill. This is also the time to look at whether your employer offers a mega backdoor Roth option or an in-plan Roth conversion feature. Not every plan has these, but more do than 5 years ago. If yours does, it can be a powerful way to move after-tax contributions into Roth space while you still have earned income and payroll infrastructure to make it easy. Another often overlooked move in these final working years: coordinate your 401k contributions with your health savings account if you have access to one. An HSA is genuinely one of the most tax-advantaged accounts available. Contributions go in pre-tax, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. If you're still working and have a high-deductible health plan, maximizing HSA contributions in these final years builds a dedicated healthcare fund that will matter enormously in Step 4. Finally, use these last working years to do smaller strategic Roth conversions if your income allows it. Converting a portion of a traditional 401k or IRA to Roth while you're still working might seem counterintuitive, but if you do it during a lower income year or spread modest conversions across several years to avoid jumping tax brackets, you can meaningfully reduce your future RMD burden and give yourself more flexibility later. The theme across this entire step is the same. Your final working years are not just about earning a paycheck. They're about actively shaping the tax character of your retirement savings before you lose the ability to easily adjust it. This is the step most people get wrong, and it can cost tens of thousands of dollars over a retirement. Here's the core idea. You don't just withdraw money in whatever order feels convenient. You withdraw it in the order that keeps your lifetime tax bill as low as possible, while also protecting your money from market risk when you need it soon. The traditional, commonly taught sequence looks like this: taxable brokerage accounts first, then tax-deferred accounts like traditional 401k and IRA, and Roth accounts last. The logic is straightforward. Let your tax-advantaged accounts keep growing tax-deferred or tax-free for as long as possible, and use your already taxed money first. But under the current rules, especially with a later RMD age, the smart version of this strategy is more nuanced. Let's break it down year by year, conceptually. In your early retirement years, often called the gap years between when you stop working and when Social Security and RMDs begin, your taxable income can actually be quite low. This is a golden window. During these years, it often makes sense to draw from your taxable brokerage accounts to cover living expenses, because capital gains on long-held investments can be taxed at favorable rates, sometimes even at 0%, if your total taxable income stays low enough. At the same time, this low-income window is the ideal moment to do strategic Roth conversions. You take a portion of your traditional 401k or IRA and convert it to Roth, paying tax on it now while you're in a lower bracket, rather than later when RMDs and Social Security push you into a higher one. This is often called filling up the bracket. You calculate how much you can convert while staying within a target tax bracket, and you convert exactly that much, no more. As you move closer to your RMD age, you shift your approach. Now the goal becomes reducing the size of your traditional accounts before the government forces withdrawals on you. Continued strategic conversions, paired with careful monitoring of your total taxable income, help smooth out what would otherwise be a sudden income spike once RMDs begin. Once RMDs start, they become the floor of your withdrawal strategy. You have to take them regardless of whether you need the cash flow. The key move here is to have already reduced your traditional balances enough through the earlier conversion years that the RMD itself isn't pushing you into a much higher bracket or triggering issues like the Medicare income surcharges we'll talk about in Step 4. Roth accounts stay untouched as long as possible throughout this whole sequence for two reasons. First, they have no RMDs during your lifetime, so there's no forced pressure to withdraw. Second, they're your most flexible tool for a big, unexpected expense, because withdrawing from a Roth doesn't create a taxable event. It won't push you into a higher bracket or trigger secondary costs the way an equivalent traditional withdrawal would. There's one more layer worth mentioning. Account location matters just as much as withdrawal order. If you hold a mix of stocks, bonds, and cash across taxable, traditional, and Roth accounts, think about which assets sit where. Generally, assets with higher expected growth are well suited to Roth accounts, since that growth comes out tax-free. More conservative, income-generating assets can sit comfortably in traditional accounts, since that income will be taxed as ordinary income anyway. The overarching principle across this entire step: don't think year by year. Think about your withdrawal sequence as a multi-decade tax smoothing exercise. The goal isn't to minimize taxes in any single year. It's to minimize the total tax paid across your entire retirement. This is the step that quietly derails more retirement plans than almost anything else, because people underestimate it so consistently. Break this into two distinct phases: the gap years before Medicare eligibility and the years after Medicare begins, the gap years. If you retire before age 65, you have a real problem to solve. You're no longer covered by an employer health plan, and you're not yet eligible for Medicare. This gap can last anywhere from a few months to several years, and health insurance during this window is often one of the largest line items in an early retiree's budget, frequently rivaling or exceeding housing costs. Your main options during this gap typically include marketplace health insurance plans, COBRA continuation coverage from your former employer, or for some people, a spouse's employer plan if one is still working. Marketplace plans deserve special attention here because of something directly tied to your withdrawal strategy from Step 3. Marketplace premium subsidies are based on your taxable income for the year. This means the withdrawal choices you make, how much you pull from taxable versus traditional versus Roth accounts, can directly affect how much you pay in health insurance premiums. This is a powerful, often overlooked connection. Managing your taxable income during the gap years isn't just about your tax bracket. It can literally lower your monthly health insurance bill. This is exactly why the HSA contributions from Step 2 matter so much. If you built up a solid HSA balance while working, you now have a pool of money that can pay for medical expenses, and in some cases, insurance premiums, completely tax-free without adding a dollar to your taxable income. The Medicare years. Once you hit 65, Medicare becomes your primary coverage, but it's not free and it's not simple. You're generally dealing with premiums for Part B, which covers outpatient care, and either a Part D prescription drug plan or a Medicare Advantage plan that bundles coverage together. Most retirees also consider a supplemental Medigap policy to cover gaps in what original Medicare pays. Here's the part that ties directly back to your withdrawal strategy. Medicare premiums are income adjusted. There's a surcharge system, often referred to by its acronym, that increases your monthly Part B and Part D premiums if your taxable income crosses certain thresholds. And critically, this is based on your tax return from 2 years prior. That means a large Roth conversion or a big withdrawal in 1 year can quietly increase your Medicare premiums 2 years later. This is precisely why the tax-efficient withdrawal sequence in Step 3 and your healthcare planning in Step 4 cannot be designed separately. If you do a large Roth conversion the year before you turn 65 or the year before you expect a big RMD, you need to model out what that does to your Medicare premiums 2 years down the line. A conversion that saves you money on your income tax bill could still cost you more in Medicare surcharges if it's not timed carefully. The practical takeaway: before you retire, build out a realistic healthcare cost estimate for both phases, the pre-Medicare gap and the post-65 years, and treat that number as a fixed, non-negotiable expense in your income audit from Step 1. Most people who get blindsided by healthcare costs didn't fail to plan for them entirely. They just used a number that was far too optimistic. While we're deep in the income and healthcare weeds, it's worth addressing Social Security directly because its timing interacts with everything we've covered so far. You can claim Social Security anywhere between age 62 and age 70. Claim early and your monthly benefit is permanently reduced. Wait until 70 and you lock in the maximum possible monthly benefit with guaranteed increases for every year you delay past your full retirement age. Delaying Social Security isn't just about a bigger check, it's a form of longevity insurance. Since it's inflation adjusted and guaranteed for life, a larger delayed benefit protects you against the risk of running out of money later in life when you may have less flexibility to adjust. Here's where it connects to your withdrawal sequence. If you delay Social Security into your late 60s, you likely need to bridge those years using withdrawals from your investment accounts. That's not a flaw in the plan. That's often intentional. You're essentially using your own savings as a bridge so that your guaranteed income source grows larger before it kicks in. This bridge period is often the same window where you're doing Roth conversions and managing marketplace insurance subsidies, so all three decisions, Social Security timing, conversion timing, and healthcare planning, need to be modeled together, not in isolation. There's no single correct claiming age for everyone. Someone with significant other guaranteed income, a shorter expected lifespan due to health factors, or an immediate need for cash flow may reasonably claim earlier. Someone focused on maximizing guaranteed lifetime income, especially if they expect a long retirement or want to protect a surviving spouse, often benefits from delaying. This is a genuinely personal decision, and it deserves real modeling with your own numbers rather than a generic rule of thumb. The final step in this framework is about protecting everything you've just built from the things you can't predict. First, market risk sequencing. A market downturn in the first few years of retirement can do disproportionate damage compared to the same downturn happening a decade in, simply because you're withdrawing money at the same time prices are down. One practical defense is keeping 1 to 2 years of essential expenses in cash or highly stable liquid assets. This gives you the ability to avoid selling investments at a loss during a downturn, drawing from that cash buffer instead while your portfolio recovers. Second, long-term care. This is one of the biggest unaddressed risks in most retirement plans. The cost of extended care, whether in-home or in a facility, can be substantial, and it's not something Medicare generally covers for long stays. Depending on your health, family history, and risk tolerance, this might mean exploring long-term care insurance, a hybrid life insurance and long-term care policy, or simply earmarking a specific portion of your portfolio as a dedicated long-term care reserve. There's no single right answer here, but there is a wrong one, ignoring it entirely and hoping it won't apply to you. Third, estate and beneficiary review. This is the simplest step on this list and the most commonly neglected. Review your beneficiary designations on every retirement account, not just your will. Beneficiary designations override what's written in a will, so an outdated form from a decade ago can completely derail your intended legacy. While you're at it, revisit your will, any trust documents, and your power of attorney and healthcare directive designations. These documents should reflect your current life, not your life from 10 or 15 years ago. Fourth, build in a review cadence. A retirement exit strategy isn't a document you create once and file away. Tax laws shift, healthcare costs shift, markets shift, and your own life shifts. Set a recurring annual check-in, ideally at the same time each year, to revisit your income audit, your withdrawal sequence, your healthcare cost estimates, and your beneficiary designations. Treat it with the same seriousness as a business reviewing its financial plan. Let's zoom back out and connect these 5 steps into a single picture. You start with the timeline and income audit, giving you an honest baseline of what you have and what you'll need. You move into your final working years with intention, using the enhanced catch-up rules, HSA contributions, and early Roth conversion opportunities available under the current system. You build a tax-efficient withdrawal sequence that treats your accounts as tools to be used in a deliberate order across decades, not randomly tapped year to year. You plan explicitly for healthcare costs in both the pre-Medicare gap and the Medicare years, recognizing how tightly connected your withdrawal choices are to what you pay for coverage. And you close the loop with a legacy and contingency layer that protects the entire structure from market shocks, long-term care needs, and outdated paperwork. None of these 5 steps work in isolation. A brilliant tax-efficient withdrawal sequence that ignores Medicare surcharges can backfire. A perfectly timed Social Security claim that ignores your healthcare bridge can leave you cash-strapped. This is a system, and like any system, it only performs at its best when every part is coordinated with the others. If you're watching this and thinking about everything you haven't done yet, the catch-up contributions you didn't max out, the Roth conversions you never started, the healthcare cost estimate you've been avoiding, take a breath. This isn't a strategy that only works if you started it 15 years ago. Every single step in this framework can be picked up right now, wherever you are. If you're 58 and just realizing you should be maximizing catch-up contributions, you still have real years left to act on that. If you're 63 and haven't touched a Roth conversion, you still have the gap years ahead of you to use that tool. If you're already retired and never built a formal withdrawal sequence, you can build one today, starting with this year's taxes rather than last year's. The retirees who end up in the best position aren't the ones who had a perfect plan at age 40. They're the ones who took stock of exactly where they stood, adjusted what they could control, and stopped worrying about what they couldn't. That's available to you at any age, in any year, including this one. So here's your actual next step, not someday, but this week. Pull together your account statements, your last year of spending, and your estimated Social Security benefit, and do the honest audit from step one. Everything else in this framework builds from that single piece of homework. If this helped clarify where you stand, subscribe for more breakdowns like this one, and drop a comment with which of these 5 steps you're going to tackle first. I read everyone, and I'll dig deeper into whichever topics you want covered next. Thanks for watching, and I'll see you in the next video.